Guys, we look at the last aspect of the financing decisions that we are looking at the optimal capital structure. All right. Like we know that assets and the current assets and the non-current assets are basically funded by the debt and the equity. So we said assets are funded by equity and or liability. Now, so we want to know the mix that will help us. All right. So we are looking at the optimal capital structure. Which capital structure is best for an entity? The optimal capital structure. Because to each source of fund, there is a cost. So what combination can we do that the cost will be a little minimal? All right. So basically, that is the idea behind this. All right. So we're looking at the key considerations. We are going to look at the practical consideration. We are going to look at the theoretical consideration, and we look at the agency concept of it. All right. Now, the practical consideration are basically the advantages and disadvantages of sticking to either equity or liability. And we looked at this from the beginning of business finance, the very first lecture on business finance. Now, practically, people want to consider the cost. And when we talk about cost, we are talking about how much it will cost us, the tax deductibility. So we are looking at, would there be any benefit? So we are looking at cost. What you should understand is that equity here, liability. What you should understand is that liability is very cheap, is cheaper than equity. Equity is expensive. Yeah, but you see, equity is also safe, but this one is risky. Why do we say that? We say that liability is cheap because the interest that you pay on the liability is allowed for you to deduct from your profit. You see, if you know your FR class very well, you know that when you get gross profit, you less selling and admin, selling and distribution, you less admin expenses, then maybe research expenses. Then you get operating profit, right? Operating profit. Then you come and less finance costs. These are the interest. So you less finance costs, including interest. When you less finance costs, that is where you are getting your profit before tax. Then you tax. So it means the interest, you are allowed to deduct it from your profit before it is taxed. But when you look at the dividend that is paid to ordinary shareholders, it doesn't come into the P&L. So that is how come liability is cheaper. And when it comes to this one too, there is issues of issue cost. So one will consider how much issue cost you have to bear in the liability or the issue cost you have to bear in the equity, and do the decision as to whether to go for equity or not. Again, gearing is risky. I mean, when you look at liability, it talks about gearing, and liability means leverage is gearing, and it makes it financial risky. So, I mean, you compare again, flexibility. Which one do you have flexibility? The liability, you have a present obligation. Equity, not by force that you have to pay dividend all the time. I mean, that's that. Cash flow profile. All right. A company going for either equity or liability depends on its cash flow profile, all right, that they have. Risk profile, how much are they willing to accommodate as risk? Limits and regulation in the country that they are they having limits on regulation as to how much liability they can have? Financial position too is about that. I mean, going concern. Liabilities are issues of going concern. Value of a business, all right, it's also another major factor. Ongoing service cost covenants. Some covenants restrict you from going into other debt borrowing. So these are practical experiences that will enable one to decide whether I should go for equity or debt. All right, that is that. Now we come to the theoretical aspect. The theoretical aspect, this is the same explanation that I've given. You could see the two opposing forces, because what we are looking at is that we would want to maximize an MPV, all right? So we want a WACC, I mean, that is a cost, but so what we want to really see is that the cost of capital, the WACC, we want to see a lower cost of capital, but we want to see an MPV that is higher, all right? Now, if your discount factor is low, your MPV is positive. You saw that if we were doing the IRRs in the previous videos. So what you see is that if your IRR, if we realize that when we move forward, anytime we move forward with our IRR, it is reducing our NPV, all right, the discount factor. You see that anytime we move forward, it is reducing our NPV. Sometimes you saw that it is even negative. So we want to minimize the WACC. Minimize the WACC. So what capital structure can we go ahead with so that we can minimize the WACC and increase our NPV? Now, the two opposing forces, like I said, is that debt is cheaper than equity because of the tax deductibility. You are allowed to reduce your profit with the interest, but equity is also low risk. On the other side, what we say is that debt is more risky. All right, that is that. Debt is more risky. So as the debt people, as equity people, is equity is less risky. But as debt keeps going up, the equity people will also start demanding a higher return. That is what happens. That is what happens. So you see, like I've said, if you have the cash flow, the market value of a company, like we always say, this is it. If you have 10 and your cost of capital is, let's say, 5, the value of your company is 2. But if you have 10 and you manage to reduce your cost of capital to say 2, your value is what? 5. So that is that. So the objective is to get a lower WACC. All right. That is basically it. Okay. So the question is that which combination will give us the lower WACC? Because a reduction in WACC is caused by it says that which it has the greatest effects on WACC. The greatest effect on WACC is that a reduction in the WACC will cause is caused by cheaper debt. That is the truth. And an increasing in WACC is going to be caused by increase in finance risk. That is basically the truth. If the company is highly geared, that is it. The things are going to go up. Now we're going to look at some theories. All right, we're going to look at some theories. And these are the theories that we are going to look at. We are going to look at the traditional theory. We're going to look at the Modigliani M&M with tax and M&M without tax. All right. But the key thing is that you have to get the assumptions down. All right. The assumptions are that there are taxes ignored in the traditional view, no transaction cost, business risk is constant, the shareholder is rational, all right, no issue cost, earnings remain constant, all right. Now, what is the traditional view saying? This we are doing is a theoretical aspect. You need to really understand it to be able to write it. Most of the time, I think last night, the examiner asked students to explain the traditional theory, for example. Now, what is the traditional theory saying? Traditional theory is saying that equity holders perceive risk as unchanged. All right. So the increase in the proportion of cheaper debt will lower the WACC. That is basically what they are saying. What does that mean? What does this statement mean? So what they are trying to say is that so far as the profit is constant, all right, the cost of capital to remain constant. Nobody in equity wants to do any change. So far as debt is cheaper. So if your debt is cheaper, equity people remain constant. There is nothing wrong. So as debt is remaining constant, equity people are also constant. So it will make the WACC lower. However, it says that a higher levels at a higher level of gearing. So everything is constant as we have it. The moment the debt side of the capital structure going up, then it means the entity is gearing towards financial risk. So equity holders see the increase in volatility of return as debt interest must be paid first because they receive their money before the ordinary shares. So they see that if a company is taking more debt, they will be paying, using their profit to be paying most of the debt holders before there is a profit after tax for them to even have their share. So once they see that loans are going up and interest will be going up, they will also start demanding more. Because as interest goes up, what you see is that it increases financial risk. That is it. And there is an increase in cost of equity. Why? Because the extra debt is being introduced and the WACC will start to rise. Because watch it, if the cost of capitals, cost of equity start rising, cost of debt start rising, then it means that everything is rising. All right. So at a very high level of gearing, there can be serious bankruptcy worries that the equity people may be seeing. All right. And debt holders alike, they will also see that, oh, they need to take their money and it will cause the WACC to rise further. And this is the graphical representation of it. That is it. This is what you see. Now look at this diagram. This is the cost of capital. This is the gearing. Now we said that when cost of capital equity is there and debt is constant, so debt is constant, you will see that the WACC is lower. The cost of equity is lower because there is no financial risk, nothing. All right. So the cost of capital, which is the WACC, will be lower. However, as the debt people start increasing in gearing, then the equity people also will start increasing their cost of equity. So that is that. So cost of equity will continue to rise so long as debt too is rising. Basically, that is that. So we find the position of WACC, the optimal mix, at the minimum of the WACC. So basically, that is that. Now, so KE, as you see, is about the cost of equity and KD is the cost of debt. So what is the conclusion? The conclusion is that there is optimal level of gearing. That is point X. I mean, where the WACC is at its bottom. All right. At point X, the overall return required by the investors, that's the debt and the equity, is minimized. So look for the point where everything is down. That is the minimal side. And it follows that at this point, the combined market value of the firm's debt and equity will be maximized. So that is that. We are looking at a higher NPV. Now, what is the implication of this in terms of finance? You see, it says that a company should gear up until it reaches the optimal point, then raise a mix of finance to maintain their level of gearing. What are we saying? The more you focus people, I mean, look at Ghana, for example. Let me give you a typical situation of what we face in our nation. Now, at a point in this nation, interest rate was okay. We were managing. That is the cost. All right. Interest rate we were managing. But you hear that in Ghana, we started borrowing a lot. So borrowing skyrocketed to the point that borrowing has consumed our GDP. Now, when that thing happened, what has happened? Go to the bank and say you are going to borrow money. Because financial risk in Ghana is very high to the extent that we have to do a domestic debt exchange program. Yeah. So what has happened is that it has made cost of capital very expensive. So that is that because of financial risk, cost of capital is very, very expensive. So that is what you see. All right. Now, the point is that the problem we have there is that when can we actually say that this is the optimal point? We can't do that. We need to use try and error. That is it. That is the problem of these theories. All right. It makes practicality very, very difficult. Now look at this situation. We are trying to tell you that ABC has 500 of its debt. The coupon rate is 10. So, and the market value is at par with the nominal value of the debt. And it has 250 shares in issue. The cost of equity is 15, while the company earns 500,000. So if we want the value of a company, we know how much it earns. We can divide it by the cost of capital. Now that this one has debt and equity, it means the cost of capital will rather be the WACC. So that's how we can actually find the value of the company. So you see clearly here This is the formula for WACC, you remember? And I told you that if you do the 1 minus t already, you don't need to bring the 1 minus t here again. And if you want to know a value of a company that has no debt in it, then it means it will be the earnings divided by the cost of equity. Only that. So let's say without this company doesn't have any debt in it, what will happen? What will happen is that the value of their profit is 500,000, and we will divide it by the cost of equity, which is 15. So when you do that, what will you have? So let's do that. Let me show you what I mean. Let's say the company doesn't have any debt in it. It means that the company is ungeared. And so what will happen is that the value of the company will be equal to the profit they earn divided by the cost of equity, which is 0.15. And what is the value of the company? So 500.15, sorry, 15. All right, that gives me, I have in here, so 0.15 multiplied by, I left 3 zeros. So that is giving me the value of a company without any debt is 33, 3, 3, then another 3, 3, 3. So we have like this. So this will be the value of the company without a debt. Without a debt. Now, if the company has a debt, then it means that if you want the value of the company, it should be the WACC. So look at this. So in that case, that we were told that the cost is this, and the company earns this thing before interest. So if we want to now bring in debt, all right, now bring in the debt, then it means we need to take out the interest. Don't forget, like I said, the profit. So if the profit is 500,000, and I take the interest, what is the interest? The interest we are told is 10%. All right, so that is what we have. We are told is 10%. So now when you do 10% of the value, you have 50, and that is what you see here. And this is the profit that you have. All right, now, if this is the profit that you have, you realize that if we do this, this is the new value of the company. That is the value of the company, the market value of the company. So you divide it by this. But hold on, the company had a debt. So it means that we need to rather use WACC. Is that not it? So if I now know the cost of capital here, and you know the cost of debt too was given, cost of debt is like it's like coupon rate. Let's say that's the cost of the 10%. Then if you go ahead and do your WACC, you realize that this is WACC is 14.28. That is that. Because you know your equity, you know your the debt, which is 500,000. All right. So this is it. 500,000 debt, not this 500,000 profit, no, 500,000 debt. And the cost to that is 10%. All right. So you have 15, 10, 503 million, and you can now do your WACC. Then you use your WACC to determine the value of the company. So now we will have to have how much. If the earnings is 500,000, this is the market value of the company. So this is how you find your WACC. So now let's use the WACC to determine the value of a company. So you see that the WACC is given as 14.28, all right? So that is what you have. Now, the company decided to do a new capital structure, assuming the company issues 480 capital at par, all right? Also, and that is it. Also at par and he said that 10% of 10% to buy back 40 of the shares, leaving for 210, because according to the question they had 250 shares. So they decide to buy back 40,000 of the shares. Then what is going to happen? And assume also that because of that, they increase the level of their gearing, and the cost of that gearing is now 17%. Then it means we know the cost of debt. We need to now find the cost of equity capital. And how do you find the cost of equity capital? This is how you go by it. So the profit before tax is this. Then the 10%, they issued a new debt, making 98. So this is what we have now. All right. So with that, I mean, what you see here is that you need to now calculate your new, you can get the market value. Of course, market value of the company is what you have as the earnings. All right, this is the earnings divided by the cost of equity. And so they said that it says, per what we have here, assume further that they increase the level of gearing and the debt and the debt, so assume further that because of the increase in the level of gearing and the debt, the attendant increase in financial risk and the debt, and there's an attendant increase in financial risk, the cost of capital increases to 17%. So now that is the cost of capital. All right. So that is what you have here. 17%. That is the total value of the company. This is what you have, especially the market value. All right. So that is what you get from here. Then you now work your WACC again with the figures that you have. Of course, this becomes the value of the company. And don't forget that in terms of debt, they already had 500,000. They issue additional 480. And so that one, this makes your WACC like this. So you see what happens to the WACC with the introduction of more debt. See what happens to the WACC. The WACC of 14.28 has increased to 14.94. So basically, that is that. So that is what we are trying to say. We are trying to say that when you push in more debt, the WACC will increase. The WACC will increase because as it stands, it's 14.28. When you introduce more debt, you see, more debt of 480, so the interest will change. And this is now the new market value of the company because the total cost of equity, the total cost is 0.7. That was given 17%. With it, you work your WACC and you realize that your WACC has skyrocketed with some points. All right. So that is that. And that is the proof that as you put in more debt, your cost of WACC, cost of capital, is going to increase. So that is the first understanding you need to get, that in the traditional theory, as you increase debt or financial risk, the equity holders start also demanding for higher return, because if they don't take care, you pay the liability people before they are coming, you come to them. And because of that, they increase their cost of capital. So basically, that is that. Then we have the theory number 2, where we look at the Modigliani and the Miller theory without taxation. All right. So this one is saying that the investor is rational. The investor is very rational. And so therefore, what he sees in that, so he said that the investors are rational. The required return on equity is directly proportional to the increase in gearing. So like we established before, that there is proportion, the proportion with which you increase your financial risk, that same proportion, the equity shareholders will start demanding a higher return. All right. So it says that there is a linear relationship between equity and debt. So that is that. And it is measured by debt over equity. Do you remember this debt over equity? That is what you use to do your ratio. So this is where it's coming from. All right. So it says that there is a relationship with the debt, and a linear relationship with the debt and equity. And it says so that he's trying to basically say that the proportion with which the debt will increase, all right, the proportion with which the debt will increase is the same proportion with which the equity people will also increase their return. So it means that we come back to the same stage, and there is no increase or decrease in WACC. And so therefore, there is what? A constant WACC. So what are they saying? They say that the proportion with which the debt people will increase, all right, the debt will increase, will be the same proportion with which equity to increase the cost of capital. And at that place, you realize that the WACC is the same. Let me use accounting as an illustration. Let's say your sales is 10,000 and your cost of sales is 5,000. So you see, cost of sales is, let's say, 50% of your sales. So you have a gross profit of what? 5,000. But let's say you increase this one to 20,000. So basically, that is that. You increase this thing to 20,000. What percentage is that? That's like 100%. Then you realize that you increase this one to 100%. That will also be like 10,000. You have 10. Proportionately, this thing is still 50% of your revenue. Still 50%. Nothing has changed. So that is what they are trying to say. Proportionately, it is the same. All right. So they said that as gearing increases, Cost of equity remains unchanged. Cost of debt also remains unchanged, and therefore WACC2 is unchanged. So as gearing increases, what they are basically saying is that even if they will move, the cost of debt will move, it will move proportionately with the cost of equity, and therefore the net effect is the same. So basically, that is what they are trying to say. And this is the diagram that manifests that. All right. So that is that. So they increase proportionately. Now, what is the conclusion? It says that therefore the WACC, when you look at the WACC, it says that the WACC and therefore the value of a company is unaffected by any changes in gearing levels. So what M&M is saying is that it doesn't matter. I mean, once the cost of equity or cost of debt is unchanged, so if you push up your debt in a company, but it doesn't affect your cost of debt, then it will also not affect your cost of equity. And therefore, the WACC2 will also not change. So basically, that is what they are trying to say. All right. But it says that the choice of financing, implication into this is that, therefore, they are saying that the choice of finance is irrelevant to the shareholders' wealth, because company can use any mix of funds. It doesn't affect the shareholders' wealth. Now, mathematically, of course, there is no tax. There's a perfect market. There is no issue cost. I mean, investors are rational. Those are the assumptions. Now, look at this. Look at this. And debt is risk-free. That's basically what they are saying. Now, if they are basically telling us that the value of an ungeared company will be determined by the profit divided by cost of equity, only equity, because the company is not geared. And so the value of this one can be determined using their dividend. Now, if it is geared, then it means that you now need to use the WACC. So that is that. There is a debt element. You now need to use the WACC. All right. And the market value of debt, we know, is the interest, post-tax interest divided by a market value of debt x interest. Okay, so basically that is that. So they provide these formulas. That's the proposition 1. All right. And the proposition 2 is the one that we use to calculate cost of equity. Do you remember? All right. So that is that. So cost of equity is the dividend over the market value of the equity. So here you see that, yeah, this is the market value of both. So equity, you can take equity, you can take that. So this is where we drew our formula from. So the dividend valuation model, where we did dividend over market value of equity, is generated from the preposition 1. The same thing for cost of debt as well. It's all generated from preposition 1. So preposition 1 is saying M&M without tax is basically saying that there is a proportionate increase in equity at the same time with gearing. And so therefore, as gearing increases, so long as cost of debt does not change, cost of equity does also not change, and the WACC is constant. Then we come to, they realize that tax exists. They realize that tax exists. So they said that, oh, if tax exists and you get interest on tax, you will benefit from interest on tax. Then an entity should borrow up to 99.999%. so that they can get more interest, tax deductibility of an interest. So basically, that is the M&M with tax. All right. But you see, the more you borrow, the more you face bankruptcy risk. All right. So basically, they are saying that gearing up reduces WACC and increases the market value. And that is the fact that because they will get interest deductibility, people should borrow up to 99.99999. But all because if you borrow, we said debt is cheap, right? So if it is cheap, then do more of it. But even as much as it's cheap, it is risky. All right. So this is the diagram that shows forth that. Okay. So basically, this is what it says, that at the start point for the theory is as before, that the investor is rational and the required rate of equity return is directly linked with the gearing. So as gearing increases, KE increases. This thing is traditional. However, this is adjusted to reflect the fact that debt interest is tax deductible. So the overall cost of debt of a company is lower. That is what they are trying to say, because it is tax deductible. Because it says that lower debt cost result in less volatility. Of course, it results in less financial risk. All right. So basically, that is that. And the increase in cost of equity does not offset the benefit of the cheaper debt. It doesn't. And so therefore, why don't you borrow? borrow. And as you borrow, your work will fall. That is basically, that is it. So that is what they are trying to say. All right. But you see, there's a problem with it. There's a problem with borrowing. There's bankruptcy risk, there's agency, there's tax exhaustion. The tax will definitely finish at a point in time. And the impact of borrowing is that it affects your credit risk and all those things. So that is the part. So for them, M&M preposition 1 is saying that basically, this is it. So preposition 1 is saying that the value of a geared company, value of a company that is geared, is equal to the value of an ungeared company plus debt multiplied by tax. That is what they are saying. Then preposition 2, we dealt with it. You remember, value of the cost of equity of a geared company is when you have the cost of equity of an ungeared company, 1 minus T, KEU minus KD, we did this, all over D over E. Preposition 3 says that we can use preposition 3 to find WACC. All right. Preposition. So in an exam, we can ask you to find the value of a geared company, where we have given you the value of an ungeared company in equilibrium. So this is in equilibrium, and we will give you their debt. So all you need to do is to multiply it with their tax. That is business valuation. We can do that. We have used this already to determine cost of equity, but we can also ask you to do WACC. So cost of an ungeared entity into bracket 1 minus D, the tax effect on debt, then the total value of a company. So that is that. So look at this example. Look at this example. Remember that we said that KD is the pre-tax cost of debt in this formula. All right. So take note of that. Now, in these formulas. Now watch this. Watch this. Grant PLC is an all equity company. That means that it is an ungeared company. And it has in issue 6 million, £1, ordinary share. And the market value of the share is this. Now, Bell is a geared company. And it has 17 million, 25% pesos, 25 kind of pound shilling, all right? That is that. So we have this one to be ordinary shares, and we have 8 million pounds, and this is how it is quoted. Look at the price. That is it. Taking into consideration tax of this. Now you are asked to calculate the equilibrium price per share of Bell. Bell is the company that is geared. Now at equilibrium, we can say that the value of a geared company is equal to the value of an ungeared company plus tax on debt. So what is the value of the ungeared company? The value of the ungeared company, this is the all equity company. That is that. And Bell is the one that is geared, and this is the capital structure of Bell. So we are going to take the value of an ungeared company. Then what is the value of the ungeared company? This is it. Its value is 6 million shares multiplying 2.5. How much is that? 2.5 by 6 million. That gives him 15 million. Plus, we now come to look at the company that has debt. So what is the debt element in this one? So we look at the company that has a debt, all right? And if a company that has we're able to find the debt, then we will be able to find the value of the company that is there. So you see, what is D? D is this. And this is the value. You remember when we used to do that. D of this company, how do you remember? It is quoted at 125. So you remember where we used to do at par and all those things. So it means that we have 8 million, nominal of 100, all right, par multiplied by 125. That is the value when we used to do the WACC question. So how much will we get as debt? So that would be 8 million. Okay. So it becomes 80,000, right? So because this 2 zeros will cancel 2 zeros and you have 80,000 and you are multiplying it by 125. That is 10 million. So you have 10 million as the value of debt. That means that the total value of a geared company at equilibrium with an ungeared company is 25 million. Now we know that in this 25 million, there is a debt component of it. So this is what you have. There is a debt component of that. Now, so this 25 million must suffer DT, tax perspective. So when we do, what was the tax rate? 35%. It's supposed to be post-tax, right? So with this one, when we bring our 15 and we do the 10 million post-tax, so 0.35 is that is 3.5 million. Post-tax perspective, you have 18.5 million. Now, this 18.5 million that you have, don't forget that we already know that debt component of it is 10 million. This is the debt component. It's 10 million. So if we segregate this, we know that debt is 10 million and equity is what? 8.5. So basically that is it. So that is what we are trying to show you. So by the value of the company of Bell is a geared company. But we will use Grant, which is an ungeared company, at equilibrium to find the value of Bell. All right, so that is that. So that is the formula we have treated. Now, if you want to find WACC with this Modigliani principle that we are doing, of course, if you want the per share one, I think you know that the shares are 17 million, so you can get the per share. Now, assuming that we were going to use this figure to do the WACC, you have to pick this one, cost of ungeared, KEU 1. E is, so you did the DT, you had 3.5. What is the cost of this company? Cost of capital. So if you want the cost of capital, it means that you need cost of equity. It's either you will use this formula so that you can make this one change of subject, all right, so that you can find cost of an ungeared company, all right. So that is that, and you can replace it here. You already have this, that is 3.5. Two of them is 18.5, all right. So you make this the change of subject, and you can find the WACC. You make this the change of subject in here. You just put in the figures. All right, you represent this one by, then when you solve it out, you see that it will come out. All right, so that is that. If you are asked to do that, that is what you're going to do. Pecking order theory says that if we want to find a proper optimal mix, then let's start with retained earnings. There's no cost. Opportunity cost is down. After that, we come to cheaper. The cheaper one is the debt, then the next one is the capital. All right, so basically that is that. So there is no issue cost in that. It's already there. Start pecking order, start with retained earnings, move to debt, then come to equity. Then, so this table exemplifies the meaning of it all right, the traditional view, the M&M, the M&M with no tax, M&M with tax. And so M&M with no tax is basically saying that your capital structure has nothing to do with your choice of finance, whether debt or equity is irrelevant. It doesn't matter. WACC will still be constant. But here it says that borrow as much as you can, as much as debt as possible. Then here, it's not really a theorized process. All you need to do is to start simply with your internally generated fund. You go to your debt, which is cheaper than your equity. We have the static trade-off theory. This one kind of have the view of the traditional a little. It's a mix of it. All right. So far as the entity doesn't change up stuff, the cost, it says that the WACC, let me read it for you so that you get the understanding. So this one is saying that there's a variation in the Miller theory, and it's similar to the traditional view. Provided a company is in a static position, with no extreme growth, then it means that it is likely to have a gearing policy that is also stable over time. And that is striking the balance. So anytime you are going to do a gearing, strike the balance with the benefit you get in the tax deductibility of the interest. All right. So basically, that is what they are trying to say. So they said that the cost of debt relates to an increase in the cost of financial distress, bankruptcy, and all those things, and increase also in agency costs. All right. And so that will rise when the company exceeds its optimal gearing level. So it says that manage your gearing level to the extent that you don't push the WACC to go up. All right. So it must balance. The proportion must balance. All right. So you have to decide which equity. Will you go for debt or will you go for equity? We have said that debt is risky, but equity is expensive but not risky. And so these are the issues. This question, there's a little question here that says that we should calculate the capital structure. That is simple. Per this one, they said that they have 10 million shares, which is having a market value of 50. So all you need to do is to do 10 million shares plus a market value of 50. That gives you like 500 million, right? That is that. Then that is equity. Then you have 3 million. Preference share 2 is 3 million and it is trading at 25. So if it is 3 million trading at 25, 3 million by 25 gives me 75 million. What else do they have? They have bonds also trading at 600 cedis. All right. So we have bond of 5 million trading at 600 each. All right. So that also gives that's 3 million. So that's all. You do that. You can find a proportion of it. So if you take the total, these are the book values. So 578. All right. So that is that. Somebody can use market value and say that this one will be 5,000 divided by 100 multiplied by market value of 600. So when you do that, how much will it be? 5 million divided by 100 multiplied by 600. That gives you like 30,000. So that is a market value. All right. So that is that. So you can do that whichever way is correct because all these things are market values. All right. They are market values. So let's say we use 0.3. Then the figure here will be 575.3. All right. So that is that. You can run the proportion. You take this one divided by this one, you get the proportion. All right. So basically, that is that. All right. So you can also use this. I will prefer this. All right. So that is that. Now it is now time for you to go in there and do your past questions. All right. With these ones, maybe later. We will do it majorly in another video. We do a past question review after everything. But take a look at it. It's not really that difficult. Calculate the amount raised through the sale of share issue. That is that. We watch the first video that talks about right issue. All right. And you understand. Compute the WACC. You should be able to compute your WACC. In May 2021, compute WACC 9 marks. July 2023, you have to compute WACC, and you have other questions that are personally developed from other sources, expecting to drop in your exam. You see, so go through them. That's why I encourage you to buy the book. Of course, when you finish everything, the solutions are there. All right, all solutions are made available. So thank you very much. This one is a short video to deal with the theory aspect. From here, what you need to really do is understand the traditional view that as gearing increases, the cost of equity people will also start to increase. All right, and the WACC start at a constant and rise up. All right, so that is that. M&M with no tax is basically saying that it doesn't matter whether you choose debt or equity, it doesn't have any impact in your capital structure. All right. So your choice of debt or equity doesn't have any impact on the share the value of the company, and therefore the shareholders' worth maximization. All right, because it goes together. When they are proportionate together, everything is still maintained. All right, then we have the M&M with tax, which is saying that because debt is cheap because you get tax deductibility on interest, and therefore a company, because the debt is cheap, a company should borrow up to 99.99%. Of course, there is financial risk there. That defeats those assumptions. We have the pecking order that says that start from internal funds, which has no issue cost, no risk. Come to the cheaper one, which is there before you look at equity. All right. So basically, if you are starting a business as a person, what it is trying to tell you that start with your own little resource. Basically, that is what it's saying. Then you will now use debt. So go to your family members, borrow some money before you structure up and invite people to come and buy equity. All right. So basically, that is that. That is what it is trying to say. All these things are in the very first video of business finance, which is theory. Go ahead and do it, and you'll be fine. So thank you very much. This is the complete set of business finance. The very first video is very important, where we do the introduction, debt and debt finance, where we do theoretical XREF price calculation and shareholders choices and their impact, where we do Islamic financing. Yeah, Buduraba, Mushuraka, Sukuk, and the riba concept of interest. So look at it and get ready for your exam. Thank you. See you. Bye-bye.